This analysis presents a really high-energy, bullish buy-the-dip argument for SOFI stock. It's basically saying the drop to $25 is a trap for sellers and a great entry point.
Yeah, you can feel the conviction right away. And that hook, tying the dip to the institutional capital raise at $27.50, that's pretty compelling. The question is, can we make the argument underneath all that excitement even stronger?
Exactly where I wanted to start. So while the report makes a really strong case for getting a discount by highlighting that $27.50 institutional price, the analysis could be strengthened by just acknowledging the market realities of that capital raise.
Right.
Right now, it leans so heavily on this idea that you, the retail person, are getting a better price than the whales. Because, Wall Street likes losing money? No.
And that's the weakness, isn't it? It relies on this assumption that an institutional price in some private deal means you're getting instant equity on the open market today.
Mm-hmm.
It's great for hype, but it overlooks some, key differences. It just feels a little naive when you present it as a sure thing.
It's an area where we can add a lot of sophistication. If this analysis is for a savvy audience, you have to show you understand the fine print.
Absolutely. So the suggestion here is to work in a quick, pragmatic bit of analysis that explains the terms of that offering. You're not trying to weaken the bullish case.
No, you're making it more robust.
You're making it more robust. It shows you get that institutional money plays by a different set of rules than, a swing trader.
So let's get practical. When an institution pays $27.50, what's in that fine print that makes it different from me buying at $25 today?
Well, you're talking about things like lockup periods. Those buyers might not be able to sell their shares for, say, 90 or 180 days.
Oh, okay.
Or maybe they got warrants as part of the deal. Options to buy more shares later, which kind of sweetens the pot for them. A retail buyer gets in at 25 and can be out 5 minutes later.
So that direct comparison, I'm buying cheaper than the big guys, it's technically true, but it's strategically a huge oversimplification.
Exactly. So to really strengthen this, instead of just using that $27.50 price as a hype tool, you pivot. You use it as like a stamp of approval. It's about fundamental validation.
And how do you make that pivot?
Well, let's look at some examples. Instead of saying you're getting instant equity, the analysis could suggest a quick calculation that shows the institutional price is actually justified by the Q3 metrics, the triple beat, regardless of the short-term noise.
I like that. That shifts the power of the argument. It's not about a short-term trade anymore. It's about long-term validation. Smart money thought the company was worth that price based on the fundamentals.
Precisely. Or another angle, you could just briefly mention that the institutional buyer's time horizon is probably way longer, right? 3, maybe 5 years.
Mm-hmm.
So that frames their purchase not as a quick flip, but as a deep belief in the growth story. The listener is piggybacking on a long-term strategic bet, not just exploiting some price blip.
That just elevates the whole analysis, moving it to sustained value, fundamental justification. Yeah, that makes the report so much more defensible. And, speaking of that raise, that brings us to why the stock dropped in the first place. That $1.5 billion offering.
And the analysis is good at pointing that out as the cause. But when it comes to defending the move strategically, it just falls a bit short.
I agree. So the report successfully addresses the root cause, the offering, but it really could benefit from a deeper, more quantitative defense against that perception of dilution.
The weakness is so clear. It just dismisses dilution by saying the cash makes the balance sheet bulletproof.
Right.
And for anyone who's been burned by dilution in a growth stock before, it's too brief. It's anecdotal. It doesn't connect the cost, the dilution, to the actual strategic benefit.
If you want to shut down the bear case, you can't just say more cash is good. You have to show how that cash is going to make more money for the company than it cost in shareholder value.
That's the point exactly. So the suggestion is to dedicate a whole segment to quantifying the projected use and return of that $1.5 billion. You move the logic from more cash is good to this cash funds specific high ROI initiatives.
So you're not apologizing for the dilution, you're framing it as a strategic investment. But how do you quantify that without seeing the company's internal budget?
You give them goals to anchor their conviction. So for example, you could model what that money will fund. The analysis could detail an ambitious but specific increase in member growth targets.
Like what?
Like, say, projecting an acceleration from 5 million to 7 million members in the next 18 months. And tying that directly to this cash injection.
Or you could tie it to product expansion, maybe? That's always a high return play for a fintech.
Totally. Expanding specific banking services, maybe rolling out new credit products, or even funding an acquisition. But I think the most powerful example would be projecting the financial leverage.
Tell me more about that.
Well, you could, for instance, outline a simple calculation of the potential return on equity, the ROE, that this cash infusion is expected to generate over the next year, year and a half.
And for anyone who doesn't know, return on equity is just how much profit a company generates with the money shareholders have put in.
Right. So instead of a vague promise, the analysis could project, say, a 15% increase in ROE driven by this new capital. Now you're demonstrating long-term value creation that completely offsets the short-term dilution.
Giving those quantitative goalposts makes the whole thing feel so much more measured. So the person reading it is no longer just trusting a gut feeling, they're analyzing a financial projection they can actually track.
If you're aiming at sophisticated investors, you have to meet their anxieties, like dilution, head-on, with numbers, not just with rhetoric.
Okay.
So now that we've shored up the fundamentals and the strategy, let's talk about the actual trade, the technical execution.
Yeah, I did appreciate the clarity there. The $25 psychological fortress as support and $27.50 as resistance. Very clear.
The levels are clear, but the analysis needs to translate those levels into a clear set of instructions, a mandate.
And that brings us to the third big critique. While the technical analysis identifies these clear levels, the final summary just lacks the concrete step-by-step actionable advice that a swing trader really needs.
And the weakness there is that the conclusion just tells you to start loading the boat, which is, high energy, but it's vague. It doesn't really match the precision of the technical analysis that came before it.
Right.
For a trader, that omission makes the whole thing less practical. They need structured entry points, and, more importantly, they need risk management.
For a report called Why I'm Loading the Boat, the how to load the boat part needs to be just as explicit as the why.
Agreed. So the suggestion is to integrate those chart findings, the RSI cooling off, the support at 25, into a defined risk management strategy. For a report aimed at swing traders, defining the conditions of the trade is just as important as the price target.
So we need to define the entry and the exit plan. How do you turn that $25 fortress into an actual trading blueprint?
You could use some concrete examples, like a scaling strategy. Instead of just go all in, maybe the analysis suggests a phased approach.
I like that.
You could detail, for example, taking a first, smaller entry right away at, say, 25.27. Then a second, larger entry is contingent on a confirmed break and close above 26. You're managing exposure, but still capturing the move.
Scaling in, it's a perfect strategy for a high-conviction trade in a stock that's this volatile. It limits your immediate downside.
And this is the most important part. You have to define the failure point. A smart analysis always accounts for being wrong. It gives the reader a safety valve.
So where would that safety valve be relative to that $25 fortress?
The analysis needs to state clearly that a confirmed breakdown and a sustained close below, say 24.50, that would invalidate the current bullish setup.
So that gives them a clear, predefined stop-loss signal.
Exactly. And that's invaluable. It takes the whole technical discussion from just an observation to a practical, executable plan. It lets the person protect their capital if the chart breaks down.
And that makes the whole strategy complete. It gives the reader confidence that you haven't just spotted an opportunity, you've also thought through the risk. By focusing on these three areas, this analysis can become a really robust, actionable thesis.
Yeah, by focusing on those three things, context on the institutional price, quantifying the dilution defense, and detailing the actual trading strategy, the whole report will just appeal to a much more sophisticated investor who wants both conviction and competence.